Mrinal, given the positive outlook for the next 5, 10, 15 years, if somebody were to invest at this point of time, so on the one hand, we have an elevated market, but at the same time, commentators like you are saying that probably the next 5, 10, 15 years, there is a lot more steam left in the Indian economy. So, should one do a lump sum at this time, or should one continue the SIP route, which has become very popular? What is your advice?
So again, a very, very relevant question, Vivek, and I would suggest a very pinpointed solution for it. If you are an investor who has access to investment advisory, you should consider lump sum or asset allocation framework along with an SIP, because you have access to advisory. So you might be able to, get your risk and financial goal assessed, and there might be a set of solutions that can be provided to you, because you have somebody who can guide you through. Okay, that you are under invested in equity, you might actually choose to have some allocation and then spread it out through SIP, or this kind of product is what suits you. But if you are a small saver who's actually not necessarily having access to advisory, I think SIP is a great way to go about it. So I would say, based on how you are in terms of a saver or an investor, I think you should choose the right kind of access to advisory would be a very good thing. And now we have the market has evolved into portfolio management services, AIFs, and mutual funds. So you might be having access to tailor-made solutions for your financial goal and risk. Advisor actually can suggest you on those lines, and it would be very good to have an advisor assess things for you and guide you well. In absence of that, I think yeah, SIP is a great method, and you should choose to target, even for people who are only doing SIP. You should choose to target a percentage of your saving going towards equity, and that SIP should actually not be a notional one, but a significant one and a long tenor one above that. Let's say most people have seen the largest bucket for SIP is in the 3-year tenor. I think it would be advisable for people, and we are a very young society. It would be advisable for people to look at 5 years and north. I have seen, and it is statistically established that the longer tenor you provide to your equity investments, the odds of you succeeding are incrementally in your favor. I mean, if you are a 10-year investor, you might have entered even at a wrong price, you will still make money. I mean, that is what time does to you. So for a society as young as ours, starting early using the SIP route, at some point you might be able to access advisory. That is something else, but don't miss out on the growth decade that India is offering. Starting valuations aren't great, but then that does not mean that there are no investable options. Equity is obviously a great way to capture the growth and be part of it. The markets will swing. There are various factors and risks that will play out, and that's a good thing. Don't look at it negatively. If markets just go one way, I mean, there won't be much returns to make. But I would say a swing is desirable because the volatility is an intermittent short-term phenomena. Use SIPs. In fact, if you think the markets are down, you can allocate even more outside SIPs. And make sure that when you are 40 or 45, a significant portion of your assets are part of the equity markets.